Then we're going to look at how you should value your tokens and what are the variables to consider and how do you apply them. So firstly, before I want to continue, I just want to put this out there that the token is used to drive the network towards a shared objective, not value on the secondary market. What does it mean? That means the token exists as a way to coordinate activities, to coordinate transactions, to allow all the decentralized participants to work together towards a shared objective. I keep talking about main objective since lesson 2 all the way to today, to now, that it's very, very important for an ecosystem to have an objective, to have the main objective it wants to achieve. Why? Because everything we design, everything we build, everything we engineer is trying to go and get that specific objective. So token as an incentive is a token as a way to coordinate activities with decentralized participants so that you can go and get that objective, go and achieve that. So that's the main purpose of tokens. That's why tokens exist. That's the incentive of tokens. The other objectives of tokens or the other purposes of tokens can be getting value on secondary market. You can do your trade, you can do your investment based on tokens. You can do that, but that's not the main objective of tokens. And tokens can have value on secondary markets, but that's not the main objective. The main objective when we're designing tokens is to drive the network towards a shared objective. Remember that. Okay, so how do we value tokens then? Once again, we have the endogenous variables and exogenous variables. We talk about endogenous variables, we look at value in the design, number 1. And then the second one is to look at engineering of the token. So value of the design is how token is designed itself. And engineering is, the kind of math formula that's embedded in the token that gives value to it. I'm going to talk a little bit more about that later. And exogenous factors, we're going to look at how market dictate the prices. And we are just going to constrain this to primary markets. So primary markets, we're going to talk about that later, but primary markets are basically the first market where the institute trades with the first person that buys it. Secondary market is everything that happens after. So let's start with endogenous factor. So first one is that it can be backed by asset. And when we talk about being backed by asset, we can talk about on-chain and off-chain. An example would be for off-chain, we have like fiat currency, we have traditional safe commodities like oil. There's oil. There are some projects that's backed by oil. I don't know if they're doing well. Some projects backed by coal, by minerals, by gold, by diamonds, or you can be backed by different kind of assets like financial assets, like government bond, treasury bills, corporate bonds, whatever. So these are assets. These are assets that exist. These are assets that already have value. What you're going to do is you peg them to your tokens, and your tokens will be a fraction or a percentage of these pegged assets. The on-chain example will be your cryptocurrencies or your crypto securities. That could be Bitcoin, Ethereum, or it could be crypto securities like there's like tokenized gold, tokenized diamond, tokenized bonds. Basically, the tokenized version of everything that you see on the off-chain side. It's possible and there are projects doing that. It's just making sure that your valuation of the ecosystem or valuation of your project is backed by something that has value. That's one. The other one is the token bonding curve. So a token bonding curve, I'm going to explain that a little bit later as a big section on its own. We're going to dive a bit deeper. But in general, just think of it as the prices of tokens fluctuates. And it fluctuates based on what's the supply in the market. So in general, it's that when the supply increases, there's more tokens being traded or there are more tokens out in the market, the price of each token goes up. So it's a price that fluctuates. It's not a static price. It's a price that is dependent on how popular your token is. So this is something that is good to consider when we are growing the ecosystem, and the prices change to incentivize different behaviors. So if you think about it, if I'm an early adopter and I keep my token, and I know that this token will definitely increase in supply, people will definitely want it. So I keep it, wait till a lot of people are in the space now, and a lot of people are demanding that token, the supply increases, and the prices increases as well, then I sell my token. So then I can earn based on that. And what's the objective? The objective is to reduce pump and dump. because as an early investor, I think, I want to hold my tokens longer because I think that the value will definitely increase because people are going to demand it more. And then when it increases, then I sell. So this is good because it helps the ecosystem to grow and you don't have a lot of pump and dump. So that's how it works. Now, how does it work when we look at a graphical analysis? Okay, what is a token bonding curve? Explain like I'm 5. So you have this line, this blue line. It's a function. It's a mathematical function that is embedded in a smart contract. The smart contract will govern this system. Okay, and basically it's a function that you can dictate. And right now we're just giving a linear function equals y equals x, a very basic function. We're going to explore the different types of functions later, but just think of it as a line. Okay, you have a graph, you have a line. Who governs the line? Smart contract governs the line. What does that mean? It means that when I want to buy 40 tokens, so smart contract will check. Okay, you buy 40 tokens, and then you go 40 tokens. You just go straight up, and they touch the line. Okay, when you touch the line, then it goes across. Goes across. Okay, it's $40. So the 40th token costs $40. That's as simple as it is. If I want to buy the 50th token, what does it do? The smart contract will say, okay, number 50. Okay, it goes across it. Number 50, number 50, number 50. Oh, found it, number 50. Then it goes up. Goes up until it touches the line. Yes, it touches the line, which is the function that we define. Then it goes across, and it hits, 50. So to buy the 50th token, the price is 50. So that's basically the token bonding curve, how it functions. We're going to talk a little bit more about that later, but right now let's move on to the second one. Let's look at savings function. What's a savings function? This is like the creepiest piggy bank that I've seen. It's so weird, I've got to share with you guys. So savings function, what you want to think about is what incentivizes people to save and hold on to the tokens. This is something that you should consider savings functions in 2 scenarios. The first one is during introduction, actually 3 scenarios. The first one is during introduction, when you just start your tokens and you have early adopters coming in. What incentivizes people to keep the tokens and not do a pump and dump scam or do a pump and dump thing? The second is when it reaches like a little bit more steady state and your ecosystem is growing. People are probably going to want to sell all the tokens, and how can you incentivize them to continue holding on to your tokens so that they can gain more as the ecosystem continues to grow? Or if it's growing too fast, what can you do to make sure that people don't sell so quickly and save the token and hold on to the token? And lastly, during crisis period. So during crisis period is where everything goes bad. No one believes in anything anymore. Everyone just wants to hold like physical hard cash. And what do you do to incentivize people to continue staying on your platform, to believe in your project, continue to save? So these are things to think about, the 3 different scenarios. So what are the methods to do that? The first one is interest rates. So interest rates on tokens. You can give interest rates on tokens. For example, in MakerDAO, you have a stable coin called DAI that's relatively pegged to $1. And DAI comes from, the value of DAI comes from different collaterals, on-chain collaterals, and the goal is to get collaterals of different crypto assets to hedge the risk. So for example, DAI will be backed by Ethereum, Bitcoin, EOS, tokenized gold, tokenized coal, tokenized diamond, maybe Tether, maybe a stable, maybe Libra. So you have different kind of things coming together to be a big basket of crypto assets to back your tokens. Now, what DAI does as well is that when DAI becomes overvalued, DAI becomes much more than $1, they need to bring DAI back down to $1. How do they do that? They increase the interest rates. So now people are more incentivized to keep DAI in the bank on their wallet and not use that. And that will drive prices down a little. and if DAI is too low, oh no, it's the other way around. If DAI is overvalued than $1, then they will reduce the interest rate. So when you reduce the interest rate of DAI, then it's more profitable for me to put my money somewhere else. Then I don't want to put my money in DAI. So the demand of DAI goes down, and when the demand of DAI goes down, the value of DAI goes down, and then it becomes pegged with $1 again. However, if DAI is lower than $1, and I need to push DAI up, then I can maybe say, okay, I give you more like interest rates on the savings. So if you get DAI, and then I can give you returns in terms of if you invest DAI, you get like a savings rate, and it increases. So now more people want to get DAI and keep that savings rate. So that's an example. The other one is transaction fees. So where you can earn transaction fees based on the tokens being held or based on the tokens being staked. So then this incentivizes people to want to hold the tokens and not sell it, because they can continuously earn like transaction fees at every period. So they incentivize people to keep their tokens. Or you have deflationary tokens. Deflationary tokens means that in the long run, the prices of tokens will actually increase. Why? Because there is a reduction in supply. So deflationary token, if you think about it, Bitcoin is quite deflationary because there is a limited supply, but the demand continues to grow. So the demand grows much faster than the supply, and so the price value, the price value will increase. So it's deflationary. Or if you think about Binance coin or Binance token, they will burn tokens to reduce the token supply, and this will increase the price level. When price level increases in the long run, that's called deflationary. So then people are just incentivized to save, because if I save one token now, it could be worth a lot more in the future because of the deflationary feature. We're going to talk a little bit more about savings function later in the section as well, so you get a better idea and better understanding. And the other variables, these are general variables that general VCs or investors think about anyway. It's not very specific it's not super specific to token ecosystems, but they're still relevant. So the first one is net present value. It's basically a formula that looks at the future the cash flow in the future, then you discount it to the present value today. So that's how you can define the value of your token ecosystem based on how much value is going to be worth in the future, then you discount it to the present. You can look at the expected value of funds, as I mentioned, because some projects are basically, when you do ICOs, you're selling tokens and you're getting like Ethereum into your project. And then what's the expected value of this amount of money that you can raise? So expected value of funds. Price equilibrium. It's a simple model where basically the total amount of funds that you raise divided by the total amount of tokens. Yeah, it's as simple as that. You can look at the demand growth, and we're going to look at demand growth in two ways. The first one is in the platform growth. So your ecosystem continues to grow, people come in, the kind of services you provide is more, or the demand of tokens growth. So more people in general are demanding a token, maybe to use your token or to trade your token. And then what's the value to the user? This is something that a lot of social media platforms are using, like Instagram, Facebook, Snapchat, I think. Basically, they find out what's the value to each user, and then they just multiply by their user base. And as the ecosystem grows, as you look at network effects, the value to user increases. The other thing is to also consider, I don't think it's talked a lot about, but it's the heterogeneity of user base. Basically, the user base have different types of people, different archetypes of people, and they have different risk appetites. So this affects how they react differently to your ecosystem. And when you have a very different type of, heterogeneity means different. If your user base is made up of very, very different people, then it's good, because then they will hedge each other's risk because they have different appetites. And then maybe your ecosystem will have demands from very different areas. And That's a lot safer because you're hedging against a different kind of risk when you have demand from different areas. You have platform productivity, so expectation of platforms growth demand, efficiency at coordinating participants, and to achieve the objectives. And lastly is viscosity of tokens. I think that's the most direct. It's deflationary in a way. You can have deflationary tokens, or you can have a limit on the tokens that's available. A lot of projects use that, the limit of tokens, but sometimes we talked about monetary policy in the last lesson. And if you have a limit on the supply of tokens, that can be quite difficult in playing around with monetary policy. Okay, and now we're going to look at getting the market to dictate. So we want to understand people's behavior. So one method is Dutch auction. That is like super funny. But one way is Dutch auction. Dutch auction is being used in government bonds, and some projects like Gnosis and Algorand use that as well. What is Dutch auction? Basically, when I sell something, I price it at the highest price possible. Like, I don't know, $100. And every minute, the price goes down, 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 down until someone wants to buy it. And basically, the first person who says he wants to buy it, buys it. And that's Dutch auction. There's like a big math analysis behind an economics analysis that I'm not going to go through here, but if you want, I'd be happy to share. And basically, it shows that this mechanism, this method, derives the highest value, and it shows the true value of how people value your item. If people value this, this item will be sold at the amount people actually value. It's a very safe, self-governing mechanism. So that's why when the government sells the government bonds, this mechanism is used, and it's quite a good way to get the value, to understand how people value your tokens. So it's being used in some projects. The other one is expectation in the future. So this is how people expect, individual people expect your token ecosystem is going to be like in the future. The first one is exchange rate. So when there is an increase in market demand, you think that the exchange rate between the prices or the price value of the token will increase, and so the exchange rate will be more favorable because people are going to demand a lot more. So it helps with the exchange rate. Or it could be a utility value. So because there's increase in the ecosystem services, there's a lot more goodness, a lot more utility in joining the ecosystem. So instead of just having your token to access one merchant, all the merchants in London are going to accept that token. So there is a higher utility, there's a higher use case in the future, and that affects how much you are valuing the tokens today. And lastly, it's valuation. Basically, the changes in token supply can affect the valuation that we talked about just now. Okay, so what is secondary markets? When we talk about secondary markets, we talk about exchange rates. Exchange rate of the tokens shows the willingness to buy. Because the higher the exchange rate, meaning the more expensive it is to buy the specific token or the currency. And so it shows the willingness to buy. It's a signal to show that, people are willing to buy that. So what is secondary market? So we have a firm over here. The firm can be a company, an institution, the government selling the bond. It can be project launching an ICO. It can be an artist creating an art, selling to the first user. So this is a primary market. A secondary market is the thing that comes after. It's where this guy who buys the digital art, or who buys the art, who buys the government bond, who buys the new ICO token, and then he sells it to another person, and this thing is called a secondary market. And everything that happens after this dude, whatever trade that's going on, it's just called a secondary market. So when we talk about getting valuation from when we talk about this thing, getting valuation from the market, it's basically looking at the primary market, which is this one, this initial transaction. And then the secondary market is where you have a lot of other crypto analysis, investors, VCs, funds, and family offices doing a lot of analysis on that. You can go and reach out to them to learn a bit more. But right now, we're just talking about primary market.